Speculation about whether the US Fed Reserve will cut its interest rate continues to be a hot topic. Market sentiments are now being shaped solely by information clearing the central bank's forthcoming actions. Recent macroeconomic data only fuels expectations of an imminent easing of the Fed's policy. According to the majority of financial market participants, a rate cut could begin as early as May next year, pushing the US dollar index to its lowest level since September 1. The US dollar index, which measures its strength against the basket of six major currencies, closed the last trading week with a 1.86% drop. A sell-off in the American currency intensified following the release of the US inflation data last Wednesday. The consumer price growth significantly slowed down, accompanied by a decline in retail sales for the first time in 7 months. So, where are investors redirecting their funds? The current background favored the strengthening of the euro. The euro-dollar pair climbed above the 1.09 level. However, it's important to note that this rise was mainly driven by the weakness of the US dollar rather than by a planned move from the traders. Data from the Eurozone also recorded a sharp slowdown in annual inflation, with the price growth rate in October hitting a two-year low. Such news naturally sparks speculation about an impending rate cut by the European Central Bank, potentially by around 100 basis points, but the timeline here is slightly different. It's expected that rates in the Eurozone will be maintained at their current level longer than they in the United States, possibly until the end of 2024. The British pound also benefited from the dollar's weakness and reached a two-month high. However, the economic picture in the UK is far from reassuring. Retail sales are in decline, while inflation decreases, indicating that the Bank of England will also likely have to start reducing rates. Again, the question is about the anticipated timing of this policy easing. Like the Eurozone, the UK is expected to cut rates by the end of 2024. The sole reason why the pound managed to gain nearly 2%. One of the most unusual signs of the dollar's weakness is that even the market's main laggard, the Japanese yen, managed to end the week on a positive note. Nonetheless, the Japanese currency remains close to its lowest level in more than 3 decades. As for the macroeconomic data, the picture is not very optimistic either. Japan's economy shrank more than expected in the third quarter amid a slowdown in global demand and rising domestic inflation. Regarding monetary policy, the Bank of Japan continues to affirm its commitment to a dovish monetary stance. Gold added 2% over the last week, marking a notable capital inflow. Speculations regarding the Fed's interest rate directly influence the appeal of debt securities. Expectations of a Fed rate cut force investors to reconsider their portfolios in favor of more profitable assets, with gold becoming increasingly attractive. For oil traders, news of the waning growth momentum in the United States has intensified concerns about potentially low demand for energy resources. The latest data from the Energy Information Administration reports an increase in the US crude inventories. Moreover, increased production by some OPEC members has also eased tensions about limited supplies following output cuts in Saudi Arabia and Russia. You have watched the combat review of a currency and commodity markets on the InstaForex TV channel. How we're going to be in the short term in financial markets, we will definitely tell you in our next news releases. Subscribe to our channel and follow news with us, and see you soon.